In 1972, investors paid any price for 50 great companies. By 1974, those same investors had lost most of their money. Not because the companies were bad, they were excellent. They lost because of the one number nobody checked. By the end here, you will check it on every stock. This is the story of the Nifty 50 crash. It is the most expensive lesson in valuation ever taught, and it cost a generation of investors their savings. Picture an investor in 1972 sitting in a wood-paneled office. His broker tells him there is a sure thing. 50 companies so good you can buy and never sell. Wall Street called them the one-decision stocks. One decision to buy, then you simply hold forever. These were the bluest of blue-chip American giants. Coca-Cola, the drink the whole world already loved. Xerox, whose copiers sat in every modern office. Polaroid, the camera that printed a photo instantly. IBM, the company that ran the world's computers. Disney, McDonald's, Avon, Kodak, Gillette, and more. These were not fads. These were the future itself. Every one of them had real earnings, growing every year. So the logic felt airtight. Buy quality, hold forever. Pension funds piled in. Trust departments piled in. Banks bought them for grandmothers and for orphans. Nobody asked what they were paying for that quality. And that single missing question is where it all broke. Here is the rule those investors forgot. Price and value are two completely different things. Value is what the business is actually worth. Price is whatever the crowd will pay today. On any given day, the two rarely match. A wonderful business can carry a foolish price, and when the price is foolish, your future return suffers. Think of it like buying a beautiful house. Buy that house at triple its worth and you lose. You still own a great house. You still lost money. The Nifty 50 investors bought great houses at triple. To see how, you need one simple tool. It is called the price-to-earnings ratio. The number sounds technical. The idea is plain. Earnings are the yearly profit the company makes. Price is what you pay to own one share. Divide the price by the earnings per share. The result is the price-to-earnings ratio, plain and simple. That answer tells you how many years to earn it back. A ratio of 10 means 10 years of profit. Pay 10 times earnings, you are paying a fair price. Pay 50 times earnings, you wait 50 long years. 50 years of profit just to get your money back, and that is exactly what the Nifty 50 cost. Polaroid traded near 90 times its yearly earnings. McDonald's traded near 80 times its earnings. Disney traded near 80 times as well. The average across the 50 was over 40 times. For comparison, the wider market sat near 19. These stocks cost double the market, sometimes more. Investors told themselves the price did not matter. They said quality this rare deserves any premium. They said you could buy these at any price. That sentence cost American families a fortune. Because price always matters. It is the whole game. Here is the cold arithmetic they ignored. A company growing profits 10% a year is superb, but if you paid 50 times earnings going in, the growth takes a decade just to justify your price. You earn almost nothing while you wait for that. And if growth slows even slightly, the price collapses. That is the trap. Great company, terrible entry price. Now feel the moment. The floor gave way. In early 1973, the market began to wobble. Oil prices spiked, inflation climbed, confidence cracked. Suddenly, investors looked at those prices again, and the question finally arrived. Is this worth it? 50 times earnings now looked insane. Not brilliant. The selling started slow, then turned into a stampede. Polaroid fell from over $100 to $14. It lost more than 90% of its value. Xerox lost over 70% of its value. Avon, the beloved cosmetics giant, fell almost 90%. Even mighty IBM was cut roughly in half. The whole market dropped nearly 50%. It was the worst crash since the Great Depression. Picture the retiree who held all 50 for income. His safe portfolio had been cut clean in half. The companies were fine. His timing of price was fatal. He had bought greatness at a ruinous price, and greatness at a ruinous price still ruins you. This is the lesson the whole decade burned in. Even the best business on earth has a wrong price. Above that price, your return turns negative for years. So how do you avoid the trap they fell into? Benjamin Graham gave the answer decades earlier. He called it the margin of safety. It is the gap between price and true value. Never pay what a business is worth. Pay clearly less. That discount is your protection when you are wrong. because you will be wrong about the future sometimes. The margin of safety absorbs your mistakes. The Nifty 50 buyers had no margin at all. They paid full price, then a wild premium on top. So when reality shifted, there was nothing to catch them. Graham's rule would have kept them out entirely. A wonderful business at 50 times earnings fails his test, not because it is bad, but because it is dear. Now here is how Warren Buffett refined the idea. Buffett loved great businesses more than Graham did. He happily paid up for true quality and a real moat. But even Buffett would not pay any price. He waited, sometimes for years, for a fair number. He let wonderful companies pass when they were too dear. Price discipline is what separates him from the crowd. The crowd of 1972 had quality but zero discipline. They confused a great company with a great investment. Those are not the same thing. Remember that always. A great company is about the business itself. A great investment is about the price you pay for it. You control the second one, you choose the price. So let me give you the takeaway to use forever. Before you buy any stock, find its earnings per share. Divide the share price by that earnings figure. If the ratio is wildly high, slow down and breathe. Ask what growth that price already assumes. Then ask if any company could truly deliver that. If the price already prices in perfection, walk away. Perfection rarely arrives. Disappointment usually does. A fair price on a good business wins out. It beats a great business bought far too dear. That single habit would have saved the class of 1972. Let the numbers protect you, not the story. Stories make you feel safe. Prices keep you safe. The Nifty 50 had the best story Wall Street ever told. 50 unbreakable champions you could hold for life. And the story was true. The companies survived. Most of them recovered and went on to thrive. But recovery took many of them over a decade of dead money for paying the wrong price. Imagine waiting 10 years just to break even. That is the true cost they never put on the tag. Time is the silent price of overpaying for quality. So carry these two sentences with you everywhere. Even the greatest company can be a terrible buy. And the price you pay decides the return you get. The business is only half of the decision. The price you pay is the half that you control. Buy quality, yes, but never at any price. Demand a margin of safety. Every single time, check the ratio. Respect the number. Stay patient. Do that. And the crash of 1974 cannot find you. The companies of 1972 were real. So was the ruin. The difference between them was one number. The price they were willing to pay. Now you know that number. Use it well. That is the Nifty 50, a lesson written in losses. If this was useful, the next episode covers margin of safety. The 50 fell, but their lesson still stands. Even the greatest company can be a terrible buy. The price you pay decides what you keep. Pay too much and brilliance cannot save you. Patience and a fair price beat hype every time. That is the discipline the crash burned in. Subscribe and keep learning to pay the right price.